Hello, and welcome to this financial analysis lesson, which will focus on costing. After you have finished this lesson, you will be able to, firstly, understand how costs can be classified for different purposes. Secondly, gain familiarity with the different costing techniques. And thirdly, understand the main costing calculations for assisting with short-term decision-making. To begin with, let's look at some goals of costing. In any organization, the level of costs can have a major impact on the decision-making process. For example, if an organization knows how much it costs to make a product, it can ensure it sets a sales price that will not only cover these costs, but also make a profit too. Knowledge of costs can also enable an organization to forecast what resources will cost in the future and help it to value inventory held in stock. Costs can be classified in various ways, depending on the different goals of the organization. If a key aim is to understand profitability, then costs should be classified according to the function they perform within the organization, such as labor or materials. This will help determine the unit cost of a product, establish a suitable selling price, or put a value on inventory. By contrast, if a key aim is to have effective planning, then costs should be classified according to their response to a change in business activity. For example, if output increases, then some costs will change, and an organization will need to know what the future cost of production will be, or what resources will be needed to meet future demand. Let's look at these cost classifications in more detail. When classifying by function, costs are separated into either production or non-production costs. Production costs are the direct costs associated with the production of goods or the delivery of a service, and are usually for materials and labor. The direct cost can also include overheads, such as factory rent, heating, and electricity, but only if they can be traced back to each product. Whether these overheads are included in the unit costs or not depends on the costing technique used, as you will see later in the lesson. Non-production costs do not contribute directly to the manufacturing cost of a product or service, but support the production process. For example, marketing, distribution, and admin costs. Now let's understand how costs react to a change in business activities. As the output levels change, costs will react in various ways. Some costs are fixed and will remain the same regardless of the level of output. For example, factory rent for the year. A stepped cost also remains fixed within certain levels of activity, but will change when these thresholds are passed. For example, insurance costs may increase when the value of the insured goods exceeds a certain level. Some costs are mixed costs because they contain both fixed and variable elements, such as telephone charges. The fixed costs of a phone are the line rental, and the variable component is the per-minute phone call rate. And some costs are purely variable, which means they change directly in line with the output of the organization. As output increases, so does the cost. For example, materials and labor. The total cost of an organization will contain both fixed and variable elements. If there is a linear relationship between output and variable costs, the equation shown on the slide can be used to predict the cost of production. In other words, total cost is a product of the variable costs per unit multiplied by the number of units produced, added to the total fixed costs. The slide shows a worked example for total costs. Please take some time to read the questions and ensure you can calculate the answers before proceeding. In this next section, I'd like to turn your attention to the three main costing techniques. But before you do, let's look at the end game here, which is to estimate the costs for 1 unit of production. How costs are allocated to 1 unit of production depends on the costing technique you use. For example, unit overheads are included in some costing techniques, but not others. Once costs have been classified and their behavior understood, you can set out the total costs for 1 cost unit. This is called a standard cost card. An example is shown in the slide. There are 3 main costing techniques: absorption costing, marginal costing, and activity-based costing. With absorption costing, all production costs are included in the unit cost of production, meaning you must attribute a portion of the overhead costs to each unit. With marginal costing, only the variable production costs are included in the cost of a unit, meaning the fixed costs are treated as period costs and are charged in full against the revenue for the period. And with activity-based costing, costs are attributed to each product based on the underlying activities that are required to produce them. It can be more accurate than absorption costing, but more complicated to produce. Let's now explore each technique in more detail. Under absorption costing, all production costs are included in the cost of a unit. The full cost of a unit is therefore its direct costs and a share of indirect overheads. Direct costs include materials and labour and can be easily traceable to the unit of production. You also need to add the share of indirect overheads incurred during the production process, but these often cannot be easily allocated to each unit. There are 3 stages in determining the share of overhead attributed to a cost unit. Firstly, ensure all overhead costs are allocated to their correct cost centres, which will usually be a production or service department. Some costs may need to be apportioned based on a fair basis. For example, rent can be allocated based on the floor space occupied by a particular production or service department. Secondly, ensure that the costs in the service cost centres are reapportioned to the production cost centres. Service cost centres are not directly involved in the manufacture of the units, for example, the staff catering department in a factory. And finally, once all overheads have been allocated and apportioned, they need to be absorbed into the cost of producing the unit. This is done using an overhead absorption rate, which you will cover on the next slide. To calculate the overhead absorption rate, you need the total amount of overhead and a basis for absorption. Here, you will use estimated overheads and activity levels, as actual figures will not be known until the end of the period. It would be inefficient to wait until then to establish unit costs. The basis of absorption could be units produced, machine hours, labour hours, or any other base that accurately reflects the cost centre. As the overhead absorption rate is based on estimates, it is unlikely that the total absorbed overheads will comply with the actual overheads incurred at the end of the year. You will probably find that overheads have either been over or under absorbed. In other words, too many overheads have been charged to the cost of production or too little. If so, an adjustment will be needed to correct the overheads charged, so they reflect the actual overheads incurred. The slide shows a worked example. If production overheads are estimated to be $10,000, and with an expected output of 1,000 units, then the overhead absorption rate would be $10 per unit. Now let's look at a more detailed worked example of cost allocation. Please read the case details and think about how you would absorb the costs using the allocate, apportion, reapportion, and absorb methodology you covered earlier. Remember, The end game here is to estimate the costs for 1 unit of production. The slide shows how salary costs should firstly be allocated to the correct cost center, which in this case are the packing, cutting and catering departments. As rent cannot be allocated to a specific cost center, it needs to be apportioned on a fair basis, which in this case is the space each department takes on the factory floor. Once this has been done, you need to reapportion the service cost centers to the production cost centers. In this case, the catering allocation needs to be reapportioned across the packing and cutting cost centers. This should be based on the number of employees in each department, which should be a fair representation of the demand each department places on the catering team. The next step in the worked example is to absorb the overheads into unit costs by using a sensible overhead absorption rate. By taking the overheads in each production department and dividing by the expected production level, you will see from the slide that $1 of total overheads should be absorbed into the unit cost of producing a chair. The final step in absorption costing is to produce your standard cost card. In our example, if we take the direct materials and labour allocations you calculated earlier in the lesson and add in the overhead allocation, it gives a standard unit cost card of $36. The next main costing technique is marginal costing. Here, only the variable production costs are included in the cost of a unit. The marginal costing approach ignores fixed costs on the argument that they must be paid regardless of income, and the apportionment of these fixed costs between different product lines can often be random. So, in our unit cost per chair example, the marginal cost of production would be $35. Contribution is a key concept in marginal costing and management decision-making. The difference between a unit's selling price and its variable cost is the contribution made by the individual product towards the organization's fixed costs. The belief here is that if enough individual contributions have been made, the organization's total costs will be covered, and it is at break-even point, making neither a profit nor a loss. A go or no-go decision could hinge on whether a product is expected to break even or not. When comparing absorption and marginal costing, each method has its own advantages and disadvantages. With absorption costing, the cost of each unit ensures that the price charged to customers covers all costs, meaning each unit includes an element of fixed cost. But a disadvantage of absorption costing is that if fixed costs are a large part of total production costs, it can be difficult to determine variations in costs that occur at different production levels. This, in turn, makes it more difficult for management to make the best decisions for operational efficiency. Activity-based costing attempts to overcome this disadvantage, which you will cover later. By contrast, marginal costing ignores fixed costs, thus avoiding the risk that overheads are allocated inaccurately and distorting profitability. But there is a risk that a unit cost's contribution will not cover all fixed costs. Activity-based costing takes the view that not all overheads are volume-based, but could be driven by other complex and diverse activities, such as machine setup times. Costs are assigned in a more logical manner, with costs assigned to the real cause of the overhead. It then assigns the cost of those activities only to the products that are actually demanding the activities. Activity-based costing focuses on linking overheads to activities to understand what drives them. In other words, each group of overheads is absorbed using a different overhead absorption rate, depending on what drives the cost. This can be done in a four-step process. Firstly, identify and then group overheads into activities according to how they are driven. These are known as cost pools. Secondly, identify the cost driver for each activity, such as the number of orders or the number of machine setups. Thirdly, calculate an overhead absorption rate for each cost pool and cost driver. And lastly, absorb the costs into production based on usage of the cost driver. In the case example on the slide, Company ABC has provided information relating to the manufacture of Product A and Product B. Using activity-based costing, what is the overhead cost per unit of Product A? The answer follows on the next slide. Using the four-step process, you can calculate the unit cost of Product A. Firstly, determine the key activities, followed by the cost drivers, overhead absorption rates, and overhead costs for Product A. Then divide the cost pools by the total number of budgeted units to arrive at a total overhead cost per unit for Product A. When comparing the different costing techniques, activity-based costing provides the most accurate costing information to assist with pricing and product mix decisions. It is most suitable when production overheads are high and not driven by volume. Managers can really get to the bottom of what is driving costs, which allows them to then deal with any non-value-adding activities. But activity-based costing can be time-consuming and expensive to collect the data, and if costs are volume-related, then it will be of limited additional use over absorption costing. In addition, even with extensive analysis, it can be difficult to understand what is driving some costs. In such cases, the random apportionment of costs may therefore still take place. In this last section of the lesson, you will look at the three types of costing calculation used in short-term decision-making. Firstly, the break-even point helps determine how many units must be sold to make neither a profit nor a loss. An organization breaks even when its sales equal its total cost. Secondly, the contribution to sales ratio tells you how much contribution a product earns per $1 of sales. This is useful to determine to what extent an increase in sales translates into an increase in contribution. And thirdly, the operating leverage measures the organization's fixed costs in relation to its variable costs, which helps determine the level of sales required to cover the fixed costs. Now let's explore each calculation in more detail. With the marginal costing technique, fixed costs are not included in the calculation of unit cost, which means there is a greater risk an organization will not cover its fixed costs. Break-even analysis is a useful tool to use alongside marginal costing, because it tells an organization the level of sales it needs to yield to break even, or to neither make a profit nor a loss. If sales exceed the break-even point, then the organization knows it will make a profit. To calculate the break-even point, simply divide your organization's fixed costs by the contribution per unit. In this worked example, you can see that the contribution per unit is $10, and the organization has fixed costs of $10,000, giving a break-even point of 1,000 units. If the organization sells more than this, it will make a profit, and if it sells less, it will make a loss. The margin of safety refers to the amount of sales over and above the break-even point. In other words, it is the amount by which sales could fall before the organization starts making a loss. As shown in the slide example, the margin of safety can be expressed in units or as a percentage. The second type of costing calculation is the contribution to sales ratio, which is an alternative way of finding the break-even point. It tells you how much contribution is earned per $1 of sales, and is expressed as a percentage and calculated as the contribution per unit over the sales price. From a decision-making perspective, once you have the contribution to sales ratio, the break-even point can be calculated, which may determine a go or no-go decision for a project. The slide shows a worked example for the contribution to sales ratio. Please take some time to read the questions and ensure you can calculate the answers before proceeding. And finally, the operating leverage calculation measures an organization's fixed costs in relation to its total cost. Organizations with a higher proportion of fixed costs are said to operate with a high leverage. For example, coffee shops or ice cream vendors. These types of store will have high fixed costs, such as rent and insurance, but relatively low variable costs for each coffee or ice cream sold. This means that the contribution to each unit sold will be relatively high, as variable cost is small, and a high number of sales may be required to cover the high fixed costs. By contrast, organizations with a lower proportion of fixed costs are said to operate with low leverage. For example, supermarkets. These types of organizations have relatively high variable costs, but low fixed costs. This means that the contribution from each sale will be relatively small, but fixed costs will be covered sooner. From a decision-making perspective, this helps indicate the level of sales required to cover the fixed costs of the organization. To summarize this lesson, you have learnt that costs can be classified by both function and behavior, and that total costs will be equal to all fixed costs, plus the variable cost per unit multiplied by total output. The three main costing techniques are absorption costing, marginal costing, and activity-based costing. And the three main calculations used for costing decision-making are the break-even point, the contribution to sales ratio, and operating leverage. Thank you for participating, and see you next time on another exciting business training lesson from Pontema.